Good morning, it's Jeffrey Christian. It's Friday, the 12th of November, around 9:30 a.m. here in New York, Standard Time. I wanted to talk today about two critical differences between gold and silver, and I'll do that in a second. Obviously, we had a very strong high CPI and PPI come out this week, and that took gold and silver to the high ends of recent ranges. And that may be a shape of things to come. We're seeing some selling off on today, Friday morning, but our expectation has been and continues to be that the prices will strengthen in the long run, and that they could strengthen in the final couple quarters. Before I talk about those critical differences, I want to amplify something I said earlier in an earlier video. On Tuesday, I used this chart, and I didn't have the word, well, I didn't have the title was just plenty of silver. And I made the comment that we had record levels of inventories. I didn't use the word market, and somebody commented on our video space on YouTube that, hey, I thought you said that there was 3.5 billion ounces of Treasury silver at some point. Clearly, then this isn't record inventories. And yeah, I forgot to say these are record reported market inventories. These are record reported market inventories, but yeah, there was a lot more silver back then. It wasn't the 1970s or whenever the fellow said in his comment, it was actually the 1940s. And it was about 3.4 billion ounces or 3.3 billion, not 3.5, and it disappeared pretty much by 1965. By virtue of the fact that the US Treasury was keeping the price of silver around 85 cents an ounce for most of that period of time. And people said, 85 cents silver, that's pretty good. Let's take it. So the US Treasury silver has gone away. On a total basis, and this big blue thing is the implied unreported stocks. These are our estimates of unreported inventories. It looks like there's about 3.3 billion ounces of silver in the world today, and this goes back to 1970. You can see that is down from where it was in the 80s and 90s. There has been, I'll show you in a chart when I get into the meat of this presentation, there was an extended period of time from 1990 to 2005 where fabricators were using more silver than was being refined from both mine production combined with secondary recovery from old scrap. And so you had a large, long 15-year period of time from 1990 until 2005 when total amounts of refined silver declined, and they declined sharply. They declined about 1.5, about 1.5 billion ounces over that period of time, a little bit more than that. So that's the silver inventories. I'm sorry if I forgot the word market, but hopefully that clarifies things and actually adds a little bit more to the knowledge of inventories. Now, two critical differences between gold and silver. I'll show you some charts in a second. First thing is, on a net basis, investors tend not to sell gold. I've said this for 40 years. A lot of people are tired of hearing me say it, but when investors get bearish on gold, they buy less gold on a net basis. Obviously, there are some investors buying and some investors selling in any given period of time. But if you take the data back to 1966, you can see the little red dots in 1969, 1972, and then again around 1996. There have only been small instances of time when investors as a whole are estimated to have been net sellers in a given year of physical gold. And this is physical gold. Now, we're not talking about papers and derivatives and all those other things that people talk about. We're talking about physical gold. Investors, when they think the price of gold is not necessarily going to rise, or when they think the world is in good shape, they buy less gold. They still buy gold and add to it. And with the exception of those 3 years, for the last, and my math is bad, 55 years, you have seen investors accumulating gold year in, year out. When they're bearish, they buy less gold. When they're bullish, they buy more gold. Contrast that to silver. When investors are bearish on silver, they sell it. They were bullish on silver in the 1960s. The US government had been keeping the price of silver below $1, which was where you could turn in silver certificates for ounces of silver, and $1.29, which is where you could melt silver-bearing circulating coins, nickels, dimes, and quarters, and then half dollars, and then dollars for their silver content. And so the US government was keeping the price suppressed. They were getting out of the silver coinage business over the course of the 1960s, and investors were buying this stuff, $1.29. And then in the 1970s, after the price rose to $2, $3, $4, they sold it. And they sold it consistently for about 8 years until the price started rising again. And then they poured in. And they were net buyers for about 10 or 11 years until 1990. And then they were net sellers. And then they were net buyers. And they're still net buyers. So one of the big differences there is that when investors are bearish on gold, they buy less. When investors are bearish on silver, they sell it. And because that leads to the second critical issue. Because investors don't sell this gold, which is bullion and coins, refined above ground inventories of bullion and coins held by private sector entities. Because they don't sell it, any new demand, whether it's from fabricators, for jewelry, for electronics, or for by investors, any new demand in gold has to be met by gold that's being newly refined, either from mine production or from scrap. Silver, because you see this reflow where investors say, I have refined bullion, I'm bearish, take my silver, please. Silver, bullion, and coins come back into the market, then they go out of the market, and then they come back into the market. But gold, new demand for gold has to be met by new supply. Now, new supply is not falling off. I've seen all kinds of weird things recently about how gold reserves are falling at the major mining companies. Yeah, they are, but they're rising on a world total basis because a lot of reserves are being discovered and delineated by not the top 10, 20 mining companies, but a lot of juniors, which is how the gold industry has always operated. So we're not running out of gold. But one of the issues is that because investors don't sell gold on a net basis, but they do sell silver on a net basis, with gold, future demand has to be met by future supply. Whereas with silver, as I showed you earlier, we have 3.5 billion ounces of silver in refined form out there. That's just bullion. There's another 2 billion ounces in silver coins that can be readily melted down and used if you really had a tight market. Silver, investors will sell it when they're bearish or when the price is really high. And they, I guess if your price really rises high, let's say it skyrockets back to $50, which it's done twice in history, and investors say, okay, I've made 800% on this. I think I'm going to take my profits. I guess he is bearish. He's saying, okay, at $50, I'm bearish. $25 I was bullish, but at $50, hey, I'm bearish. So investors will sell silver bullion and silver coins, where when gold investors get bearish, they say, hey, I just won't buy more this year. That's one of the big differences. Those are two of the big differences between gold and silver. That's really all I wanted to talk about today. I wanted to keep it relatively short and relatively focused. I did want to, amplify my comment and point out that I was talking about market inventories because God knows I'll be criticized by somebody out there who has nothing better to do with his life. And that's it. We will be having our open forum next week on Wednesday, the 17th of November. It's an hour of time where we'll have an open webinar, no presentation. People can send us questions. We've already received a couple questions by email, had please address this or that, or they can ask the questions at that time. And it's just an hour where people can ask us about issues like, hey, how is it that the top mining companies have a profile that shows falling reserves, but yet they've actually had that profile of falling reserves pretty much every year of their existence, because that's the nature of mining. As you mine, you use up reserves and you need to replace them. And how do you replace them? You find those little companies or smaller companies. Some of them are not so little. You know, Newcrest bought Pretium this year, or has announced that it's buying Pretium. Pretium is a fabulous company that in a record amount of time almost built a very large mine in British Columbia that's now putting out, I think, about 500,000 ounces of gold a year at very low prices. Newcrest is a larger company, and it bought Pretium, and now it has a massive amount of reserves and resources that it's adding to its portfolio. That's the way the gold mining industry always has been, and it will continue to be. We also have various retail investor programs. You can read about CPM Group on our website. There is an introduction in the YouTube, and there's probably all kinds of stuff in various corners of our website that would be of interest to people. Of course, you can always subscribe to our yearbooks, $160 each, our Precious Metals Advisory, which is a more in-depth report. It came out yesterday. It's about 43 pages this month, I think. It's a monthly Precious Metals Advisory. You can buy a single copy to see what it's like, and then you can buy a full year subscription if you want to continue with it. And most of our work is consulting, and most of our revenue comes from consulting services that we provide investors. So we're around. Let us know if we can help you. Thank you. Goodbye. Take care.